and welcome to our special programme on the US jobs report with me, Victoria Scholar. We're live on the IG platform, on Facebook, on YouTube and Periscope. With just a few minutes to go until the data release, let's recap the expected numbers. We're looking for 195,000 in June. That's for the headline non-farm payrolls number. According to 73 economists polled by Bloomberg, the range is between 154,000 and 242,000. Last month's reading came in at 223,000, so we'll be looking out for any revisions there. Meanwhile, the unemployment rate is seen holding steady at 3.8%. That's the lowest level since April 2000. And that all-important average hourly earnings figure is expected to remain at 0.3% in June. That would be no change from May. Year on year, that figure is seen rising to 2.8% from 2.7% in May. Let's check in on how European markets are trading ahead of the release. As we can see, it's red across the screen. Modest losses with the FTSE 100 leading the declines, down by 0.35%. And let's check in on how US equities are trading on the IG platform as stock markets get set to open stateside in just over an hour's time. As we can see, also negative prints. The Wall Street cash down by 1/3%. The US 500 cash down by 1/4%. And that followed a volatile session in Asia, with markets rebounding into the close, clawing back from 9-month lows amid rapidly increasing trade tensions between the US and China, of course. US tariffs of $34 billion came into effect just after midnight in Washington, and China responded shortly after with retaliatory tariffs. The Nikkei in Japan outperformed in Asia, closing up by more than 1%, while the Hang Seng closed up by 0.5%. And of course, we're yet to see how the jobs report might weigh on the balance between the buyers and sellers in the markets. Switching to forex, here's how the major currency pairs are trading. Many investors, of course, likely taking to the sidelines ahead of that all-important jobs report. The US dollar is continuing to retrace that bullish trend that developed in Q2, and that's moving hand in hand with a bullish move in the euro dollar. Euro dollar currently up by 0.25%. Joining me now for a quick first word as we await those all-important numbers is Mike Ingram, Chief Market Strategist at WH Ireland, and Chris Beecham, IG's Chief Market Analyst. Mike, if we can start with you. Yesterday we had the ADP private employment number. That came in at 177,000. That was a touch softer than forecast. Do you think we could possibly get a softer headline figure today?
Yeah, that's quite plausible. I mean, if you frame this print more widely, we've had macroeconomic data which has tended to somewhat disappoint during the course of June and into July. So, for instance, if you look at the employment subcomponent of the most recent ISM PMI reports, both were misses. JOLTS job openings, Challenger jobs report, University of Michigan. I mean, there's quite a long list here. Now, none of these were disastrously weak, but, you know, as you say, I would characterise them as soft numbers. And overall, you get the feeling that activity did take a little bit of a pause during the course of June. That's likely to be reflected in the print that we've got today. And of course, you know, we're still digesting those Fed minutes from last night. Was also talking about concerns over investment and how long is it that before that's going to be something of a drag on the employment number.
No, I definitely want to touch on those FOMC minutes after the release. But if I could just bring you into the conversation a sec, Chris, we're looking for 0.3% on average hourly earnings month on month. That's no change. But let's not forget back in February when we got that stronger than expected wage data coming in for the month of January. That's what sparked the initial sell-off. So could we see selling if wages come in strong?
I think the market's started to adjust to this idea now that we wanted improvement in wages, and finally you get it back earlier in the year and then the market sold off. I think it starts to say, no, we are comfortable with this idea. Now we're seeing the reasons for why wages are beginning to strengthen. It is, after all, a good thing for the economy. And US markets have had their sell-off now. Perhaps they looked prime for sell-off back in February. They don't look quite that bad now. You've got risk sentiment really back towards pessimism. So I think it might prove to be quite a boon for the US economy, particularly as this trade war stuff ramps up, concerns that will hit growth as well.
Now, it's just around 30 seconds until we get the data release, so let's recap those expected numbers. We're looking for 195,000 on the headline non-farm payrolls figure. That's for the month of June versus May, 223,000 we got last month, so we'll be looking out for any revisions there. 3.8% is what we're looking for on the unemployment figure. Average hourly earnings year on year, 2.8%, and 0.3% month on month for average hourly earnings. And I've heard some whispers that we could potentially get a softer number on the headline figure, but we'll have to wait and see. So just to recap once again, NFP June headline is forecast to come in at 195,000. Now we've got the numbers. It's 213,000 for the headline number. So that's a beat on consensus. There we go. It shows the perils of forecasting. I was completely wrong there. On the unemployment rate, wow, 4%, 0.2% higher than expected. The expectation, remember, was for 3.8%. Let's check in on how markets are reacting to the news. Chris, what are we seeing in terms of the market reaction? Well, if you look at the immediate near-term reaction, you have the US dollar selling off rapidly. That's the 5-minute chart, so the short term, of course, and then again bouncing off the low. So there are reasons, I think, to suggest that this is, again, a relatively strong number. Headline beat, of course, always good on a Friday number, really chivvies up things as we head into the weekend. Average hourly earnings, 2.7%, expected 2.8%. So it's a softer print on the average hourly earnings there. No fears for inflation then. Of course, we were concerned before that it might be pushing up inflation, this higher wages, but now average hourly earnings coming in at 2.7% year on year. That's softer than expected, 0.2% month on month compared to the forecast for 0.3%. Let's get instant reaction now from the IG trading floor. IG's Hannah Lucas joins us now. Hannah, what are you seeing in terms of the flows and where are the volumes?
Hi guys, so apologies, I don't think my camera is working. As you would expect, we're seeing a lot of movement in the dollar crosses, specifically cable and euro dollar. There's been a lot of pressure on dollar recently and clients are taking advantage of volatility around this release to sort of really get in and out of positions. Also, again, we've had a big spike up in Wall Street like you would expect.
And Hannah, I wanted to just ask you about the week ahead because we've got US earnings season coming up for the second quarter. That will unofficially kick off on Friday with results from JP Morgan, Citigroup and Wells Fargo. So is that what your clients will be focusing on in the week ahead?
Definitely. So amongst the usual chat about trade war, Brexit negotiations, this is something new for clients to focus on. We've got another 3 popular companies with IG clients coming up, likes of Ocado, Barrett and Burberry. So definitely a busy couple of weeks ahead.
Hannah Lucas, thank you so much. Let's bring Mike back into the conversation here for a second. Initial thoughts?
Bit of a Goldilocks print, really, isn't it? I mean, higher growth, lower inflation. You know, the Fed may actually have to, rein back a little bit of its hawkish 4-dot plot, rate hike rhetoric. Yeah, I mean, I think it's a reassuring number for markets. And as you say, that sentiment has in any case deteriorated. We're coming from a relatively low base, and the Fed has to some extent put the market on alert on rates. So we'll be surprised to see a bit of a relief rally in risk assets on the back of that. So
the dollar index is up around 6.5% since the trough in February, and it's been trying to get back up to that 95 handle and not really getting there. Do you think the dollar bulls are running out of steam?
I think we're certainly in a consolidation phase just from, they've seen a big swing during the course of the year. I mean, we are, I think, just about in positive territory. Was it 1.5% for the year? So, it's been a wild ride. But it'd be quite interesting to see what the forex forecasts are doing, because they always seem to be pretty reliable lagging indicators. And when you see a nice downtrend, then everybody's forecasting it to continue to decline. And almost inevitably, when you see that sort of capitulation of the last bull on these currencies, that's besides the time it troughs and it comes back again. And this year on the dollar, that was absolutely no exception whatsoever.
Now, I know you mentioned the FOMC minutes. Of course, we got those overnight. And I think one of the interesting things was how much trade wars was being talked about. Obviously, those trade tensions really ramping up overnight. Is that the biggest risk to markets for you?
Yeah, it is. And ironically, the more we talk about trade wars, the more damage it will do. Because at least at the level that we're at the moment, in terms of what tariffs are actually being imposed, the direct economic impact is actually relatively minor. It's the second and third round effects in terms of business and consumer confidence on investment and employment. That's what really does the damage. So ironically, we are here contributing to some extent to the downside risk associated with that. But yeah, I mean, for me, this is all about politics. It's nothing to do with economics. You just look at where Trump is in terms of the electoral cycle. He's got midterms in November. His approval ratings, amazingly enough, I always find it strange for somebody sitting here in the UK that his approval ratings have gone up over the last 6 months. So they're now sort of 45-ish, I think, which is sort of peak level since inauguration. So as far as he's concerned, he's doing great. With the right thing, he's getting rewarded. He's going to carry on doing it for the next few months.
Well, one fund manager from Resource Credit Income Fund in New York said that the Fed could find itself potentially directly targeted by President Trump as we run up to that election in 2020. What do you make of those comments?
He doesn't like institutions containing his executive power. He doesn't like multilateralism. He has questioned the usefulness of a fully independent Fed. None of the Fed appointments he's made so far, or the nominees so far, have really rang any alarm bells. But of course, we're just one angry tweet away from something quite dramatic.
Now let's bring Chris into the conversation here. Another key part of the FOMC minutes last night was this discussion about the yield curve, and we've been seeing that it's been flattening, and of course we know that an inversion is seen as a precursor to a recession. So do you think there's any risk of a Fed-induced recession?
I don't think it's so at the moment. I think we shouldn't be too careful about the yield curve, really. It's moving towards that flattening, but you get it's a sort of an amber warning for the yield curve. When it starts to invert, then you get another 18 months on average since the 50s before you get a full-blown recession. So it's sort of, if you look at the sort of 1999, when the yield curve inverted, that the S&P then moved up another 13% before it started to fall. So you can still see markets moving higher before the yield curve inverts. It's a warning. It's not a sign of worse to come. I think you are seeing risk assets again recovering in the wake of this report. We deployed the Goldilocks name for this because that's an echo of last year. Everything's been moving in such a nice direction. This is just enough, I think, to keep everyone happy with the direction of the US economy without worrying too much, again, as we said before the release, about that spike in inflation.
So what do you make of the inflation picture? Because we saw US May core PCE come in at 2%. That's the highest level since April 2012, which is a strong sign for inflation. Yet today's employment report perhaps points to a different picture. We're seeing average hourly earnings fall short of expectations and unemployment coming in above 3.8, coming in at 4%. So a weaker employment report there.
It is, but the PCE continues to move in the Fed's direction. And remember, the PCE is the one that they watch. We've got US CPI next week, but everyone sort of focuses on that and forgets that what the Fed actually watches. Things are moving in the right direction. Powell seems very happy with how things are at the moment. I think the big question for the next few months into 2019 is really how many more rate hikes, how many more dot plots move, and will you get a sort of change where every meeting becomes live? We get a press conference after every meeting. That's the interesting, I think, development heading into next year.
And Mike, I want to get your take on the outlook as we go into the second half of the year. Obviously in US markets there was a very mixed performance, the Nasdaq outperforming, the Dow underperforming, S&P somewhere in between. And the French market watchdog this week, AMF, said the #1 risk in 2018 is a brutal correction for stock market prices. So are we approaching peak equity market valuations?
I should probably be careful what I say here. It's clearly getting more difficult, and I mean, for instance, we've been plotting things like what's going on in emerging markets. Sort of what was initially just an outright dollar liquidity squeeze has actually transformed into something of a mini credit crunch now. So yeah, that fantastic tailwind that we had, that sort of melt-up environment we had in 2017, that is very much in the rear-view mirror now. I think we're going to see more volatility. Are we peak equity market? Well, I mean, I think, despite the concerns about global growth, you're not really seeing a significant dip in growth forecasts at the macro level. And by and large, companies are delivering on earnings. The issue is what rate do you discount? Is there a greater risk premium out there discounting those cash flows, discounting those earnings? And I think the answer has to be yes.
Chris, if I could just bring you in, one of the big events next week will be US earnings season, as I mentioned earlier, kicking off with those bank earnings next Friday. I know you've been writing about it on the IG website. What should we be looking out for? Is it the revisions, or should we be concerned about the dollar?
I think we should be looking out for the signs that the US economy improvement is reflected in those bank earnings. I think that in an environment of rising rates, they'll do better. I think everyone's much happier with the tax reform as passed. And the macro outlook for banks, I think, remains very strong. The sector's taken a terrible knock of late in terms of performance, but you've seen it start to recover. I think, again, it's the kind of sector you should be looking for in earnings season to do well. It's beneficial as well as people move away from the hype of the tech sector. So, again, US earnings season, a crucial one for markets, but banks should continue to signal that the stock market is in relatively healthy territory.
All right, well, let's have a quick last check on the markets if we can as we wrap up this special monthly non-farm payrolls program. As we can see, the markets have now turned positive. The US Tech 100, that of course is the Nasdaq, trading up by 1/3%. The Wall Street cash not far behind, up by 0.1%. And let's just quickly recap those numbers for you that we got in the jobs report. We got average hourly earnings for June year on year coming in at 2.7%. That's below forecast for 2.8%. Month on month, again, a slight miss, 0.2% compared to expectations for 0.3%. The headline figure, 213,000. So that was a beat on expectations, while unemployment came in at 4%. So really a curate's egg of a report, if you will. Eurodollar is currently trading up by 0.5%. Cable up by 1/3%. And the yen just gaining some strength there. Thank you to my guest, Mike Ingram, Chief Market Strategist at WH Ireland, and IG's Chief Market Analyst, Chris Beecham. Thank you guys so much for watching IGTV. I'm Victoria Scholar, and remember to find me on Twitter at VictoriaS_IG. See you soon. Have a great weekend.